You risked 13,000 for 250 bucks. You're damn right I did. And what you're missing about that is that you have the wrong trader psychology here. You're thinking that I put that entire $13,000 on the line to make 250 bucks. And that is one of the reasons why you are not making either money or able to lock in gains. Because your idea is whatever money I put into this market, it could go to zero immediately. That's why you let the computer do the work for you. Remember, before I take a play, I automatically write off how much I'm willing to lose. So as soon as I buy $13,000 worth of this, I say, am I okay losing 130 bucks? Sure. 1% trailing stop loss. And the second that it drops 1%, if I buy and it immediately drops 1%, guess what? I lost 130 bucks and I'm back. I would say risking 13,000 with a bottom I'm risking $130. That's what you're missing here. I didn't risk 13,000. I risked 130 bucks because I let the computer do the work for me. But I'm giving myself unlimited upside because it can ride as long as it wants up and that trailing stop loss will follow. Once it goes up 1%, I can't lose money. The opportunity cost of deploying the 13,000 though, once again, you're looking at it as though, well, 250 bucks is when you're risking 13,000. I'm not risking 13,000. I'm risking 130 bucks because the moment I bought it, I put a 1% trailing stop loss. What if the market falls so fast the stop loss fails to sell in time? Then I have a lot more problems than that dropping 10% and losing 1,300. If the entire market fell so much that one stock also went down 10%, then I've lost a lot more in my overall net worth than I did on that play. And when you say opportunity cost, that was 18 minutes. Opportunity cost is still there. Now, I'm not telling you guys you should throw 13 grand at a play. Absolutely not. I'm saying understand the value versus what the ROI is, okay? And for me, I let the computer do the work for me. I've been doing this long enough that the reason that you're probably looking at this is you've probably done that thinking you're going to get a certain amount of money and lost a bunch because you let your emotions, you let you and what you believe and what you think and what you're seeing in the TA and everything do it for you. I don't do that. I let the computer do the work for me. So I ended up seeing that. Now, that means I could have walked away with 500 bucks because if I got up to a certain amount and it dropped and it kicked me out at 1%, that means I was up higher. Sure, but I let the computer do the work for me. So I go into a play automatically accepting how much I'm willing to lose, and that's where I set my trailing stop loss. And as it moves up, my trailing stop loss goes up. Even if it goes up 0.25% and it falls, I'm going to lose less than I was already comfortable losing. So you may look at that and say, that's not worth my time, Stocky. I need 10% on a play before I make it worth it. Okay, then stick to your strategy. The way Stocky does it is the way you become consistently and actually making money. You never become consistent in making money. You become consistent in negating losses, which then allow you to make money when it's green, right? So imagine if you had 5 trading days and 4 of them were blood red. And one day you ended up, you got into some trades, they didn't work out and you minimal losses, then the market's tanking, but you got out with minimal losses. Then the next day you get a couple trades and you get minimal gains and you're even, right? And then, it does that. And then all of a sudden there's a big green day and all the trades you make skyrocket. Well, because you didn't lose all your money on all those bad days, you now make more, you have more capital to ride on the green days. That's the idea. I always tell you guys, I approach this market different than almost every other person online. I'm not about squeezing out, making all this money and making, to the moon every day. No, for me, it is way more important to protect your capital than it is to expand it in this market. That sounds stupid. That sounds absolutely dumb. What is this guy talking about? What the hell is this guy talking about? What does he mean? What does he mean? It's better to protect your capital than to expand it in this market. What I mean by that, guys, is that it doesn't matter how much money you make when the days are green if you have, if you lose it all when the days are red. It doesn't matter how much money you make if you give it all back. You have to protect your capital so that you can expand it when the days are good. All right. And a lot of people misunderstand that. Everybody FOMOs and says, oh, this person made $1,000 into $50,000 in a week. Great. They're going to be negative in 2 weeks because they're only focusing on what can go right and not what can go wrong. It's like people who go through their entire life without having proper insurance, life insurance, car insurance, home insurance. We don't expect things to go wrong. I add little bits on the way down. I don't think the bleeding is over. There's way too much economic indicator. And I think that if the next GDP report comes out as negative and it puts us in an official recession, that'll cause more selling. But, I'm still adding little bits on the way down because this is going to bottom out eventually, whether it's at the 22% average, bear market, non-recession bear market, or the 47% average recession bear market. Regardless, it's going to bottom out eventually. I just don't know where, so I'm not trying to time it. So I'm just adding smaller bits on the way down. I bought a little bit more PayPal at 76 the other day. I bought Walmart yesterday at 124. But I'm buying like 5 shares here, 5 shares here every time the market has a really bad day. When we go green again, like last week, I don't buy on the way up. Not until we have like monthly buy-ups. Because whether it takes 1 month, 10 months, or 10 years, it's going to come back. It just depends on where we're at. So every reset, every market, bearish market we've had has taken less and less time to gap back up. But that's because they've all been for different reasons, and we've printed our ways out. Like, for example, 2008, we didn't drop rates to zero until after the market had fallen and then cleaned up. We did it this time after the market fell on the COVID concerns, then gapped all the way back up, and now we're raising rates instead of lowering them, and we're going down. You see what I mean? So it's all unprecedented. This reminds me in a lot of ways of the 2001 dot-com bubble, but not the same because it's a whole different world. But I'm more of a fan. The ones that I'm picking up the most of right now, though, are Microsoft and Google. Google with the split and Microsoft because of they don't have the same economic and supply chain and inflation pressures that big box stores do. But like I said, I don't know where the bottom is. I could see us getting down as low as 340 at some point this year. I don't think we will, but it's not out of the realm of possibility, depending on what we see as far as, if we have another shutdown in China, or if Russia, gets aggressive again, or if the Fed decides to pop points again. There's a lot of factors out there. So I'm just watching it. I'm not saying it's going to get to 340. I'm just saying I could see a scenario where that happens, is what I'm getting at. So instead of trying to completely choose and pick and choose and try to find the bottom, I'll just stick to my strategy, which is day trade, days where I have good days, take some of that profit, stick it in cash, leave it on the sidelines. And then when there's a really deep red day, take that profit and buy a little bit of my long-term stuff and do the same thing over and over again until we finally find a bottom. Because you know what? The market is not going to be this low in 20 years unless we go into an absolute fucking cataclysmic financial rug pull that takes a long, that fucks up a long time, right? If I'm buying on the way down, I'm just accumulating more and more and more at a cheaper valuation, even if the market stays flat at the bottom for years. Because remember, you guys have to get out of the mindset that this is all the money you're ever going to have. And so you have to make the biggest bang for your buck now. No, it's fine. These shares are going to go down. But the money that you make next week, next month, next year, whatever, and you just keep buying on the way down, even if it flatlines at $350 for 2 years, you just keep accumulating. And then when the market does go back up and gap up, you're fucking banking. That's the idea. That's why you can't wait for the bottom. I mean, there's some stats out there that show if you miss the 10 greenest days in a year, you go from making an average of, if the market over the past 10 years has averaged 9.1% a year, and you missed only the 10 greenest days, you only averaged 1.1% or something like that instead of 9%. Think about that. 10 days you miss account for 90% of the profits for the year. Just throwing that out there. No, I didn't say never miss a day. I'm saying that's why you can't withdraw everything out of your portfolio and say, I'll just get back in at the bottom. What about missing the 10 reddest days of the year? Well, the only way you're going to miss both the 10 greenest and 10 reddest is if you're not in the market at all. And then you're just, you're at mercy of inflation. The financial system is broken. It will die at some point. At some point, yeah. But as long as humans are in charge, humans are greedy, and humans will find ways of accumulating wealth.